It's the longest day of the year, but today's show will help you get through it.
Look, things are going to slow here a bit. We see it in the economic data. The Fed will probably come forward at some point with lower rates. So that doesn't mean a robust earnings environment, but certainly one that is likely to be strong enough to support a higher equity market from here.
That's Brian Levitt, global market strategist at Invesco. And he's thinking the market has room to go from here, not necessarily for a spectacular year, but not likely to be something that should amp up your worries. And speaking of your worries, Nate Astle is here. He's a certified financial therapist with Beyond Finance, which did a survey of American men, and it found that their financial stress and their mental health are deeply intertwined with each other. And oh, by the way, they're feeling the strain, and it's affecting their emotional well-being now. All that, plus John Cole Scott, president of Closed End Fund Advisors, is here answering your questions and mine about closed-end funds.
So let it be written. So let it be done.
Yeah, well, that's the show we described to you in our show notes, so it's written there and it's done here. Welcome to Money Life for Friday, June the 20th. I hope you enjoyed Juneteenth, enjoyed the day off. It's a little bit of a weird week. And in fact, that created a situation that I can tell you in the entirety of Money Life has never happened before that impacts today's show. Now, you know, we have done somewhere around 3,300 shows at this point in this iteration of Money Life. Doesn't even count the live radio days and the pre-podcasting whatever days as we did other things. No. This iteration of the show dating back to April 30th, I do not believe the situation we have today with one of our interviews that's not on the show has ever come up. And that's because I was supposed to speak with Jeff Crumpelman. We're going to be talking technicals with him. He is with Mariner Wealth. Love chatting with him. And when we set the interview, we set it for Juneteenth, not thinking about the Juneteenth holiday. If you understood how I set up my booking calendar, I have to remember to pull the holidays off. And Juneteenth doesn't jump to the front of my mind. So he said, let's talk on June the 19th. Okay, no problem. And then as I'm putting it into the book, I'm like, that's a holiday. I should get back with Jeff. And he goes, I'm going to be working on the holiday. Are you? And I said, well, yeah, I'm going to be working at least a little bit. He goes, let's do the interview. Great. So we were all set up to do the interview. And then a funny thing happened. I got so busy with the fact that I was not doing most of my work because everything but the interview with Jeff was taped before we got to Thursday's holiday, that I stood him up.
You imbecile! You bloated idiot!
Yeah, I blew it. He waited for me. I was off doing some things, helping, using some help with a neighbor and what have you. And the next thing I knew, I'm like, oh my goodness. And he had waited more than enough time. And then he was planning to do the interview with me and then take the rest of the day off. So we did. So we will have him on another show. And yeah, I don't believe I've ever stood anyone up for an interview. It has happened to me plenty of times. Yeah, I feel very bad about that. But again, Jeff Crumpelman, happy to come on the show. And we've already said we will get him back. We'll get the date picked up and I'll let you know when that's going to happen. Meanwhile, we are, of course, back to the market a day after we got the news from the Fed, which was not really much news. But what you did get was more dislike between the President of the United States and the head of the Federal Reserve. And I'm waiting to see if this thing spills over into something that we heard about. Scott Bessent, the Treasury Secretary, in October of last year, he actually suggested naming Jerome Powell's successor more than a year early, which would essentially tell Jerome Powell, sit down and stop doing what you're doing, even though Powell is in the driver's seat. It would be like saying, hey, I understand that the captain is flying the plane. Let's pick another captain because I don't like the turbulence to sit over the captain's shoulder. And we have had President Trump say that he intends to choose the next Fed chairman soon. So I don't know what we would expect. We may get a sense of it. There is a Fed governor's term that expires in January of 2026, and that may give us a look at what he is considering. By the way, if I had to bet, it would be Kevin Hassett, certainly loyal to the president. He also, by the way, was the co-author of Dow 36,000, a book that basically, I think, killed the bull market of the 1990s. You've heard me talk about it in the past. I'm not going to jump to worst case scenarios, etc. But again, if you wind up with a shadow Fed chair, that could hurt the economy. That could hurt the markets. Again, I don't think we're going to see rate cuts this year, but if we do see them, and I'll ask this question of Brian Levitt in our interview, but I've asked it to others, are we going to get the kind of impact we would like from rate cuts? Because we didn't get it last year. And that wasn't a political thing. It was not about who was in power then, or it's not about who's in power now. Current conditions do not necessarily lend themselves to the idea that, oh, there's a rate cut and now the market takes off. And oh, by the way, can you look at this market and not be pleased with the fact that it recovered? Like, if you need more out of this, is that because there's more coming that might hurt this? Because everyone is saying it's pretty well set up. So that's what we will be watching. That's what I will be asking about. I'd love to get your take on it. Chuck at moneylifeshow.com is how you reach me. But right now, you've reached this show and we've got great things for you. Again, today's lineup: John Cole Scott talking closed-end funds, Nate Astle talking mental health, men's mental health, and the ties it has to finances, and then Brian Levitt from Invesco with the big interview. The Navigator kicks us off right after this message.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
You have questions about closed-end fund investing? And so do I. Let's get some answers from John Cole Scott of Closed End Fund Advisors. Welcome to the Navigator. This is the Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing all facets of the closed-end fund industry, from users and investors to fund sponsors and creators. If you're looking for excellence beyond indexing, the Navigator will point you in the right direction. Returning to the Navigator today, John Cole Scott, president at Closed End Fund Advisors in Richmond, Virginia, which is online at cefadvisors.com. And as he talks about the data that his firm produces, you can dig into that for yourself as well at cefdata.com. Beyond his own firm, John is chairman of the Active Investment Company Alliance, which you can learn about at aicalliance.org. John Cole Scott, welcome back to the Navigator.
It's always great to be with you, Chuck.
I want to start with my question before we get to a couple of audience questions. And my question comes directly out of the Active Investment Company Alliance BDC Forum, which was held in New York City on Wednesday, June 11th. And you at that event were on a panel with Mitchell Penn, who's managing partner at Oppenheimer. He did an interview for the Navigator from the event. You guys were talking about investment prospects for BDCs. And he was asked to provide a few favorite BDCs. And of course, you provided a few options as well. And you periodically have given us your investment ideas here on the Navigator. But watching the session from the audience, I was struck by something. And I had a question, because Mitchell is as knowledgeable about the BDC space as anybody out there. And I'd say the same for you. But he's an analyst. He's analyzing funds that Oppenheimer will put on a buy list. And you are an investor. You're analyzing funds and actively putting them into or out of portfolios. You're moving things around pretty dynamically. So I'm curious, how do you see the roles, analyst versus investor, as different? And what are the differences and how do they apply to investors?
Absolutely. So at a basic level, the analysts I speak to, they generally cover about 25 funds versus investors like CF Advisors that use them for client portfolios have to cover pretty much 45, I'll say all the liquid, non-broken funds. And also, from my understanding, I'm not in their seats, but they pick great managers. They do the financial models every quarter. They model leverage and earnings and all the important data points that we also collect at CF Data, but they're not as tactical because they're not making daily trades. And so just through, whether it's Mitchell or other analysts we're friends with, when bad things happen, they basically don't dramatically change their list in a day or a week. Versus at CF Advisors, if Chuck, if you're my client, if something goes down and go, can I rotate to a better upside? Can I capture a tax loss? Is there a reason to sell or add to the sector? Like I'm growing my BDC exposure. I'm lowering it based on the asset allocation decisions, the research we do at CF Advisors, just like the other 10 or so firms in the space. And so, like, for example, again, TSLX, he mentioned as one of his top picks. And an audience member who's a data client who has our data goes, well, they're at the top end of their 52-week price range. And the answer is yes, TSLX is a wonderful example of a high quality manager that should be regarded as a benchmark for great behavior and credit underwriting and ROE, which is return on equity. But generally speaking, at our firm, we're not buying the top of 52-week range. We're looking to wait for a tactical investment at a reasonable price for any BDC.
So now that we've got that one out of the way, I want to get to some questions we have from listeners to the Navigator. The first comes from Al in Orchard Park, New York, who writes, "Hi, Chuck. I have some questions about closed-end funds because I never owned any until I started listening to the show. And now I bought one or two, and they look very good to me. But I also have questions because the more I know about them, the less I think I know. I'm afraid I'm making a mistake by doing this. I know that premiums are supposed to be a bad deal, but funds that trade at a premium can issue new shares and grow the fund. So a premium is not necessarily bad, or is it?" He's got more questions. Let's start with that one.
So I would say that he is correct. A fund at a premium, especially a fund that generally trades at a premium, can do a really beautiful thing of an ATM or at the market offering to drip new shares in the market, slowly growing the fund at a general not detriment to current shareholders, which is a positive factor. However, if you think about it, and again, I recognize a passive holder, a more active holder like a firm like ours, we're always looking for the best spot, tax appropriate, not just selling to sell for any reasons. But the premium often leads to the potential when there's a market turmoil. So most recently, April of this year or other time periods we've talked about, where the downside pricing direction of a fund relatively expensive to itself or its peer group is almost always worse on the downside. The short answer would be maybe if he never sells, it eventually bounces back up, and that is possible. But to me, when the average basket closed-end funds moves over 20% in a 3-year period, you should be willing to make asset allocation and entry point decisions, if not as active as CF Advisors, reasonably active as an individual investor.
That answer probably fits very well and dovetails into Al's second question. So again, from Al in Orchard Park, New York, he continued with, "The funds that I bought to be long-term investments. My plan is to hold them until I either get paid the discount or I think there's something better out there." And he notes parenthetically, in my investing history, that doesn't happen very often. And I don't know whether he means there's not something better out there or he doesn't sell very often because he thinks there's something better out there. He goes, "Or I could sell them if they have a loss near the end of the year when I can do tax loss harvesting. But that means I have a lot of reasons to sell them. So should I even be thinking about them as long-term? Shouldn't I just be sizing them up to see if they can narrow the discount soon? And shouldn't I plan to get out of them quickly? If they're not long-term investments, maybe I don't want them after all."
So in some ways they can be. The only caveat being you shouldn't ignore concepts. Like at our firm, we start with the trifecta analysis, analyze the discount, analyze the dividend, analyze the NAV, then be thoughtful in asset allocation. So even if you ignore the first three, which are very important, sometimes you'll be overweight US versus international. Sometimes you'll be overweight high yield versus senior loan. Sometimes you want to be overweight energy versus utility. And that is an opinion, but there are data points you can analyze to lean into that outcome, which means that generally most investment portfolios should be nudging at the minimum over the course of time, at least based on our premise of investing. And so I would say that, yes, we have tools and time as CF Advisors. We have to overcome a management fee to be of value to our clients. But in our work from our longer portfolios, we've often been able to do about 2% after fees over a passive basket. Not every client, not every time period, but longer, like 10, 15 plus years. So by being active, you should be getting extra return. But also by being active, you're seeking better return, but you also be thoughtful on trading short-term gains for taxes, and also harvesting losses for a tax benefit.
One more question from Alan in Orchard Park, New York. He asks, how do I know for sure if a closed-end fund is returning capital? Is there an easy way for me to look at a fund's yield and see that it's not real, that some of it is me getting my money back and drawing down the fund? I'm definitely drawn to big yields, and I don't think I bought anything that has been paying me back my own money, but I'd be upset if I bought my next fund tomorrow and then learned that the payout was fake.
First off, there's like the 2 year ago comment of return capital that's detrimental is not as common. It's easy to navigate a course around them. Because of activism, we've talked about regularly on this show that there is overpayment distributions. The goal would be, how do you calculate that as an investor or an advisor supporting your clients? We would argue that leverage adjusted NAV yield for a sector versus a benchmark expectation is a starting point. We look at the NAV total return over the time periods that make sense to you to measure a manager to see if they're actually performing independent of distributions for a number that makes sense to you. You then can look at the 1099 if you've held it for over a year to see if there was return on capital. But at a basic level, if there is excess returns and if you paid a reasonable discount, it is a tailwind with one caveat I've said probably, I won't say 100 times in our show, but at least 15. Reinvest a portion of the dividend, and generally speaking, for a diversified mix of the 20 or so funds, it's going to be about 15% back into the corpus. Take out the rest as potentially durable income, but you can currently not take everything from most funds, and you shouldn't avoid funds overpaying if they're good funds at reasonable discounts that fit your asset allocation mix for that part of your portfolio.
Let's now turn to a note we got from Charlie in Snohomish, Washington, who wrote, hi, Chuck. We met when you spoke at an AAII meeting in Bellevue. That would have been in 2019, I want to say. And he said, and I've been listening ever since, but I've never written before. I work with a money manager, financial planner. Are they all one thing? That's one term used together. And the latest thing he recommended I buy is an interval fund. Are interval funds worth the risk? Limited liquidity, higher costs in exchange for higher returns and diversification. I assume I can get diversification in other ways. So is it really just higher returns? It's the first time I've ever really questioned anything he has suggested. But I'm thinking this is a good idea for him, but not so great for me. What do you think? And he didn't tell us exactly what was being suggested, because he said that his advisor had suggested 2 interval funds, but one of them is one where we have had the manager here on the Navigator, that being the Blue Bay event-driven credit fund, or that's what he called it. It's the Blue Bay Destra International event-driven credit fund that is one of the interval funds. So interval funds worth the risk?
Part of it comes down to where is it in the portfolio. The why, yes, for interval funds there are, as you've talked about, there's managers that they fit in baskets. They usually live in, private funds with less transparency, higher fees. A well-built interval fund is a good piece of part of a portfolio that you're rounding out with traditional regular stocks and bonds, even the more esoteric closed-end funds in that wrapper. The why not would be too much in it, not the right manager in a wrapper, worry about being stuck in it, which can happen. So you should not put the short-term money in interval funds. We use it actively at CF Advisors in a very beautiful way for the right manager. We do own the Credix Fund. It's a great fund. As I think about, and I don't know the question fully as you don't, which share class is the advisor selling? And so at a basic level, you and I both know some advisors work on commission, some work on building fee-based portfolios where the fee at the fund level is independent from the compensation of the advisor. Generally, I'm pro. Find an advisor building you an annual fee you can live with, and he builds you whatever things should be in it, whether it's an ETF, a closed-end fund, a BDC, or interval fund, and then it's disconnected that compensation. So if it's commission share class, I'd be very thoughtful on why is that the relationship you have. And if it makes sense, just know that. But the fee-only share class can be a very powerful one. It's a little bit lower cost to you. If there's no back-end fees and whatnot that can happen, because an interval fund is operationally in that way like a regular open-end fund. There's A, B, C, I, and other share classes. And so at a basic level, we generally keep interval funds when used for clients no more than 2 to 3% per position and no more than 15% per account, because sometimes people have to replace a car, buy a refrigerator, or deal with a child that needs extra expenses that wasn't in their 12-month plan.
John, great stuff. Love getting the questions. Love getting your answers. Thanks as always for coming on the Navigator. We'll talk to you again soon.
Always great to be here, Chuck.
John Cole Scott is president of Closed End Fund Advisors. He's the chairman of the Active Investment Company Alliance. His firm is online at cefadvisors.com, and you can dig into their data at cefdata.com. To learn more about closed-end funds, interval funds, and business development companies, go to aicalliance.org. It's the website for the Active Investment Company Alliance. And if you have questions for John or about closed-end fund investing generally, email them to thenavigator@aicalliance.org. We're just getting started on Money Life for June the 20th. Our big interview will feature Brian Levitt, global market strategist for Invesco. But next, we're talking about men's mental health and how closely it's tied to their finances, especially in these tricky times. And we're doing it with Nate Astley of Beyond Finance. Stick around. Now Money Life looks at what the survey said. Welcome to The Survey Said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today, it's not so much what they're doing when it comes directly to their money. It comes down to how their money makes them feel, because we are looking at a study that was done for Beyond Finance, where they surveyed 2,000 men to take a look at the link between what's happening with their finances and what's happening with their mental health. And we know that money is a huge source of stress in relationships and all the rest. But these days, with so many things happening, with people feeling that they can't avoid their finances and feeling like there's trouble when they go to the grocery store, or the gas pump, or whatever, this is a really interesting piece that, not surprisingly, found out that the worse you feel about the finances, the worse you feel generally about pretty much everything. Here to discuss it, Nate Astle. He's a certified financial therapist working with Beyond Finance. If you want to learn more about the firm and what they do as counselors, beyondfinance.com. Nate Astle, welcome to Money Life.
Hey, thanks so much for having me. Excited to be here.
There's no surprise in this, given how emotional money can be, et cetera. And you guys studied specifically men. I'm wondering, was part of what you expected to find is that so much of a man's identity is tied up in finances, that obviously bad finances have bad mental health? Or is it also things like bad inflation, which affects us, but it's not under our control, also is creating bad mental health?
All the above, I think is the best way to put it. We know from a lot of research that mental health and financial health are deeply connected. They always have been, and they likely always will be. But I think what this survey is really showing is, one, just how deeply connected it is, but also the different pressures that I think men experience because of some of these internalized roles. Like, because I'm a man, I'm supposed to have it all together. And if there's one area I'm supposed to have my life in order, it's supposed to be money, which is not fair, not realistic. Like, this isn't something we all were just born knowing, but it's something that unfortunately our culture has set us up to feel like this is what it means to be a man, is to be a financial provider. And I just think that there's more to it than that. And yeah, there's a lot of depth here, I think, comes out of the survey.
One of the things that I found interesting was you guys took a look at what are often considered financial infidelity factors, things that one person keeps as a secret from their partner. It's not just men that do this. This can be both. But they range from, I've got a secret savings account, I've got a secret credit card, I've got spending habits that I don't want my partner to see, to I've got cash reserves, or I've got investments that I don't want them to know about. I found it interesting because a different part of your study, but other studies as well, have looked at when we see mental health around money deteriorating, we also see certain behaviors get worse. So I was stunned that there wasn't, what I'm keeping from my partner is a gambling habit, or the fact that I'm blowing off my stress by going off and betting, which is now so much easier to do. So help us understand the level of financial infidelity and where the betting problem is. Because if it wasn't in your list of factors for financial infidelity, where does it go?
One thing we do know is stress can lead to shame, and shame leads to secrecy. So again, all of this is very equal no matter what gender you are. But when we're experiencing high levels of stress, it's really easy for us to feel like, it's all my fault. It's because I'm stupid. I'm bad. I'm bad with money. I'm a failure. And it's oof, those are really, really heavy thoughts and feelings and beliefs about yourself. If I am feeling that shame, I'm much more likely to keep it secret. And I'm glad that you brought up these different examples of financial infidelity because sometimes, unless it's something kind of glaring, like I have a secret credit card, those are maybe the more in your face examples. But financial infidelity can also be things like I lied about how much something costs, or I omitted certain things so that it didn't feel as bad as it was financially. I think with the gambling thing that you're bringing up, that's just another form of coping. Like really that's all that's happening is I'm under stress, I'm feeling shame. My partner will be mad at me if I tell them, "Hey, I've been online sports betting," or maybe my partner is fine with my online sports betting under a certain limit, but I've gone above that limit. Regardless of what the actual coping behavior is, what matters is our relationships hurt because of it. Because eventually you get caught or found out, and now you've got trust issues and you've got other strains going on. So all these things are tied together, and it's a big deal.
Where the study was pointing for me was men are emotionally being overtaken. They're being overwhelmed by the responsibilities around money, and they don't ask for help. I guess there's two different sides to this. Now, I recognize I am talking into your book as a certified financial therapist, but is there a difference in terms of the help they are seeking and emotionally the help they think they need and whether they feel weak or strong or what have you? If they're seeking the help of a therapist versus seeking the help of a financial advisor, because we also know from plenty of studies that results turn out better and people have more confidence if they're working with advisors. But if you're not seeking help at any level and you feel shame in your behaviors, well, if you feel shame in your behaviors, maybe you go to a therapist, but not an advisor. But does it matter where they're going? Does it change where they're turning for help based on how they view their problems?
Yeah, really good question. And honestly, it's one of the biggest problems with, in my view, both financial advisors and therapists is financial advisors are obviously trained and skilled in numbers help, but quite frankly, most financial advisors don't get training in psychology and counseling skills and some of those things that actually matter a heck of a lot. And on the flip side, most mental health practitioners get very little training on finances. And so, no matter which professional you're going to, unless you're going to someone like me, like a certified financial therapist, you you kind of are only getting one half of the equation. So, as far as like which is easier for men to go to, I think one comes with less stigma. Going to see a financial advisor, oh yeah, that's a good responsible thing to do. But unfortunately, mental health stigma is still a thing, but I think it's getting better. It's certainly gotten better in the last 20 years, but we had to see financial issues not just as a numbers problem. We know money and mental health are inherently connected. You've never had an unemotional money experience. And so if we can remember that, like, oh, maybe part of my issue is how I cope with difficult emotions, how to identify difficult emotions. We also know from a lot of research that comparatively, men get a lot less exposure to emotion language. Men are culturally allowed to be angry, and that's about it. But we're all human beings. We all experience fear, sadness, disappointment, loss. What we need is to be able to say, hey, this is part of the human experience. It shows up in my money, and here's what I can do about it. Let me move forward in this area of my life. I'll get off my soapbox.
And they have to find the right way. As you said, every transaction is basically an emotional experience. You just don't always recognize the endorphins that you're releasing and what they're doing and everything else. It's really interesting stuff. Beyond Finance did this as part of Mental Health Awareness Month, which is June. Nate, thanks so much for joining me on the show to talk about it.
Of course. Thanks for having me.
Nate Astle is a certified financial therapist. He works with Beyond Finance, which you can learn about at beyondfinance.com. Again, you'll find the study, and we've got information that gets you directly there in our show notes or where you find Nate on our guest page. I'll tell you what, if Money Life is your financial therapy, stick around because there's a lot more on today's show to go, and that should make you feel better.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at vetify.com.
Welcome to the big interview on the June 20th edition of Money Life. Returning to the show today, Brian Levitt, global market strategist at Invesco. If you want to learn more about the firm and what they do, it's Invesco.com/US. Brian Levitt, great to chat with you again.
Always great to be back, Chuck. Thank you.
You guys just came out with your mid-year outlook, and it's been a really interesting year because, well, frankly, it's not that as we sit here in June, we're looking at a market and an economy that is way off from what most forecasts were. But the journey we've had to go from where the 2025 initial forecast was to where we are now has been very different than what's expected. So are we still getting to the destinations in the next 6 months that you thought we were getting to, or have things changed more than that and we're going to be taking a different path?
I think we're still getting to the destinations that we thought we were getting to. If you think about the beginning of the year, you're right. The setup for the economy was good. Good growth environment, inflation pretty stable in the U.S. It wasn't until March that we started worrying about policy uncertainty. You got a correction. Liberation Day put us more into concerns about a recession or even a crisis. And since then, the market has generally been looking ahead to what they believe will be a better policy mix. So I came into this year expecting some volatility around policy uncertainty, but ultimately was of the belief that the growth and inflation backdrop were going to be supportive for corporate earnings. Obviously, tariffs came in a little bit higher than I expected. Israel and Iran is a little bit of a curveball, but ultimately, I still believe the markets are heading higher.
But how much higher is a big question. And in that answer, you talked about earnings. For the last couple of years, a lot of the return we got on the market was driven by what the Fed was doing. This year coming in, and I believe the last time you and I talked, we were speaking about this. I know it was part of Invesco's thing. You guys were saying earnings were going to drive it this year. So we've had good earnings, but I'm not sure we've had the earnings that everybody expected, and we still have a lot of uncertainty. So just how good are the earnings and just how positive are we towards the end of the year? Because, I mean, are we getting to a double-digit plus year in 2025?
Probably not. I mean, there was a challenging start to it, so you had some room to make up before we advanced. So after back-to-back 25% up years, probably wasn't in the cards to have big outsized gains. We're middle to pushing on a bit later in the cycle. You would expect your returns to be more modest than they would be very early in the cycle, but if you look at the way the corporate bond market's behaving, the way high yield spreads are behaving, there's nothing to suggest that the end of a cycle is coming. So look, things are going to slow here a bit. We see it in the economic data. The Fed will probably come forward at some point with lower rates. So that doesn't mean a robust earnings environment, but certainly one that is likely to be strong enough to support a higher equity market from here.
You mentioned the Fed in there. We are doing this interview on the afternoon of the 18th, just before the Fed comes out and tells us what's going on, but we're not particularly expecting anything strange out of the Fed. The question is, those rate cuts that you talked about, you said they'll probably get to it. When? You think it's coming this year?
Yeah, I'm not all that concerned about the actual timing of it as of where we are right now. Look, inflation expectations are contained. That's the big thing to me, Chuck, the 3-year inflation break even, which of course is the bond market's expectation of inflation, was heading up towards 3 at one point, now back at 2.5. The 10-year break even's been very stable. So what does that suggest to me? It suggests the Fed has restored their credibility after 2022. It also suggests the bond market is viewing tariffs as more of a price shock than a sustained period of inflation. Why is that important? It means if we do start to see cracks in the labor market, or when we start to see cracks in the labor market, the Federal Reserve, so long as inflation expectations are contained, will likely start to ease. So it remains to be seen if that is September or December. But again, my mind, what matters, or maybe even the beginning of next year, but what matters most to me is that inflation expectations are contained. And I believe the Fed will respond if the economy starts to weaken meaningfully.
The interesting thing about the rate cuts last year was that they did give us the positivity in the stock market, but they didn't do what we expect rate cuts to do. We didn't wind up seeing mortgage rates go down. We didn't see some sort of significant change in the bond market as well. Are we in a market and conditions right now where if we get the rate cuts, the expectation is, for all of the ancillary effects, the classic things that people want and hope for out of a rate cut? Or are we getting more of what we got last year?
I don't think it's going to be a magic pill to the economy or a magic elixir. I mean, the same way that rate hikes didn't lead to a recession, probably because most of us have fixed rate mortgages, or good CFOs at businesses had locked in lower rates for a long period. So I wouldn't expect it to lead to gangbuster economic activity. But what we're looking at right now, when you have a flat yield curve, it suggests that Fed is a little bit too tight. And if you start to lower rates, there are parts of the market that will benefit: smaller businesses, companies that need to roll debt, parts of the financial sector. So it's not as if it doesn't have any impact. I would argue, while we didn't have a broad-based recession in 23 or 24, you did have parts of the economy or smaller businesses that were under duress. So it can help. I don't think you're going to see lights out economic activity, or you're going to see a substantial broadening of markets. But if you're at a point when the yield curve is flat and the economy seems to be slowing, it typically behooves you to bring rates lower.
In that answer, given everything you said, what I get is a sense that you don't believe a recession is coming, at least not anytime soon.
I don't believe a recession is coming. I would be a lot more concerned if we weren't having such a good year in the corporate bond market. I mean, usually think of high yield bonds as being a canary in a coal mine. And when volatility was spiking after Liberation Day on April 2nd, you did start to see some spread widening, but off of a very low level. Chuck, we didn't even get to average, let alone even starting to think about a recession environment. And those spreads have since come in. The last I checked, I think high yield bonds have actually outperformed equities this year, at least the S&P 500 this year. So to me, that is not an environment that typically presages a recession. You also look this year, industrials have done well, which also is an environment that typically doesn't presage a recession. So the market is certainly not suggesting recession. It makes sense. This is not an economy that appears to have too much excess in it, or have too many businesses and banks way overexposed to leverage and debt. So no, I don't think we're heading into a recession.
When you consider the conditions that we've got, obviously tariffs were a big deal. You were talking about inflation, and you suggested at least that the tariffs have been a one-time hit really to inflation, but I'm not sure that we've seen it yet. And obviously, we've got July 9th to get an understanding of what's coming and what's more likely to be long term. So is that a storm cloud for you? Or do you think we've seen the worst of it? We may get another little pop, but not a long term.
We definitely have not seen the worst of it. If you look at the imports into the United States, we had a surge of imports ahead of the tariffs, and that has now come back down to or it's actually fallen pretty sharply. So that surge in imports getting ahead of the levies was actually a positive in keeping the inflation rate relatively contained. So yeah, we get to July 9th, we'll start to feel more of the impacts of it unless we have further delays or further negotiations. My point is that, yeah, prices will go up, and you're likely to see the Fed's preferred measure of inflation back up over the comfort zone. But the question is whether the Fed feels as if they have to respond to that which I don't believe they will. In 2018, when that happened, they, of course, lowered rates in 2019 because they were worried more about the impact on growth than a sustained period of inflation. And it's why I watch those inflation break-even numbers so closely right now. But Chuck, it's like in every one of these cycles, we find a new indicator that matters so much to us. I'm sure you remember in '08, we were looking at things like the TED spread, right? What's the interbank lending rate looking like? Right now, to me, it's the inflation expectations data. If that can remain contained even in a near-term price shock, then I think the market will generally look through it.
And let us hope that we get through it and then we don't have to remember that statistic the same way that interbank data kind of gives me a little bit of nausea. Just even the subject coming up and the idea that I might have to explain it to an audience, just a little queasy there.
Yeah, just mentioning the TED spread, right? It's the
Exactly
today's
right.
magic word.
Something that has made investors queasy for a while has been international investing, and then they got better and healthy. So where are you right now in international investing? I mean, I've read the outlook, so I know where you're going to go with this, but there is a real question for some people whether or not the pop that we've seen and the push that we've seen in international has now played out, and they want to be saying, okay, I got what I could, and I'll still stay more focused on domestic. So where are you not only on international, but on the balance between international and domestic?
Well, it's funny if, after a 20% move, that's all of it, but it's underperformed for 15 years. So, obviously there's potentially more to go if the right conditions exist. So when I think about international markets, it starts with the dollar. And, of course, the dollar isn't plummeting. It's been weaker this year as U.S. growth potentially converges with the rest of the world. I look at policy. We've talked about the Fed. The Fed may have to go at this a little bit slower because of the price shock coming that we talked about. Whereas in Europe, in the UK, in China, they are pursuing more accommodative policies. Earnings momentum had been better in Europe and China. It's a little bit of a mixed picture right now. So we're looking for a reacceleration in earnings momentum. But the reality is you take all of that, valuations more attractive, the dollar under a bit of pressure, policy more likely in your favor outside the United States, plus the Germans spending some money on defense and infrastructure. It's likely to unlock some of the value that exists out there. Now, if you think about it, U.S. investors maybe wonder, well, do I flip U.S. to international? No, that's not what we're talking about. We're talking about investors having basically no exposure to international for a very long period of time because they felt like it added volatility to the portfolio without a coincident level of performance. But, in a nice environment where policy is accommodative and activity can pick up in other parts of the world, you would think you'd want to have 15, 20% or so outside the United States.
Given that and everything else you see, what industries are you leaning into? What industries are you staying away from, both, again, domestically and internationally?
Well, I tend to think of it more from a factor perspective in terms of the environment you're right now favors more quality. So you want to be exposed to those parts of the markets that are higher quality as we wait to see, particularly in the U.S., how we come out of this. If we get through this period, and quality in the U.S. is largely technology, getting through this period into a better policy environment and a renewed pickup in economic activity, that's when you want to take on, more value oriented, more size in the portfolio. I think over the long term, I mean, the themes that we've been talking about for some time now, automation of the workforce, artificial intelligence, everything that hangs off of it, I think is still very interesting. I'm of the mind, though, that the broader market hasn't even begun to assess this yet. When you think of the productivity gains after the tech bubble that went down to a lot of different industries, I'm not even sure we're beginning to contemplate all the implications that has for healthcare and financials and probably everything that we do.
We were talking just a second ago about international. We were talking about where you want to be going. Given what we have coming, how much are you worried about geopolitical risk? And is the geopolitical risk our inability to get things done? Like we could be facing a fiscal cliff again this summer. Or is it the things that we're seeing around the world where, we now have Iran and Israel added to Russia, Ukraine, India, Pakistan, China, Taiwan, trade wars between China and the US, et cetera. help us kind of understand your priority of which of these things is scary and you're worrying about, which one you watch just because you're human and you watch this.
Right. I watch all of it, obviously, for being human and, obviously being concerned about it. But I've always believed that conflicts, that as so long as they stay regional, tend to not meaningfully disrupt the economic trajectory of the largest economies. So a conflict between Israel and Iran, no matter how tragic it is, probably does not change meaningfully the growth trajectory of the US, Europe, China, and probably doesn't change what their central banks are going to do. So, for the most part, that is likely to play out in the background, unless there's some event in the Strait of Hormuz that leads to, natural gas prices spiking or oil spiking. That would be a different story. That could potentially change the trajectory of those economies. But in its current form, that would seem unlikely. I think Russia-Ukraine, similar story in that, some early concerns about European energy sources, but for the most part, it has not changed the trajectory of the US or Chinese economies, or even really the European Union. So those would be less so. Those are going to play out in the background if investors want to hedge. We obviously own some commodities in the portfolio that could be impacted by it. Trade war is a bit different because the lack of clarity around the trade war can change the direction of economies. And you're seeing it a bit in business sentiment and what will that mean for durable goods orders, these types of things. So that one's a little bit more worth watching closely. Again, the market did come pretty close to pricing in a recession fairly quickly. Now the market's pricing in we're going to get better outcomes than had previously been expected. My whole thing with tariffs, Chuck, is that you'll get a less optimal outcome. Somebody has to pay for them. Maybe they're worth it to protect national security or whatever else. I'm not running for office, so I'll let the politicians decide that. But they don't have to derail the cycle. But we got to have clarity. So the sooner we know what they are, the economy is likely to adjust and consumers are likely to adjust.
Are you doing anything to hedge that lack of clarity, like gold, commodities? Where do they stand in your outlook?
Yeah, I think gold and commodities have a part. I mean, that goes back to the home insurance stuff, right? Like nobody wants their house to get destroyed, but you're happy to have it. So I view that more as insurance. Surprisingly, and some may be surprised with this, I think international perhaps as well. You may say, why international? Those are, some of the biggest international economies are export driven. Why would you want to be there? And it comes back to that idea that they're going to have more deflationary impulses, which means probably more stimulus from the government, and they are trading at more attractive valuations.
So as we wrap this up, you and I typically talk maybe twice a year, about 6 months between them. So we just got through what you were talking about in the 2025 mid-year outlook. And I'll point out for the audience that if they look in our show notes or they look and find you on our guest page at moneylifeshow.com, they will find a link directly to Invesco's mid-year outlook if they want to dig in and get a little bit more of some of the background on what you're talking about. But given that you're pretty benign on the conditions that we've got, and given that clarity is so important, and given that in your role, you're going to start working on the end of the year outlook, yesterday? Like as soon as you hit print and put this thing up, you were working on the next one. So give me your longest lens out and tell me that if you had to bet right now on what you and I will be talking about when we have that conversation near the end of the year, will we be looking at a 2026 that feels as benign and genuinely kind of it's okay, not great, but not terrible as we are now? Or is 2026 the year when trouble comes home to roost?
I don't think it's a year when trouble comes home to roost. I would view it more as a period where we've just gone through a bit of a growth scare. That's why we like quality investments here, and we're starting to look ahead to greater policy accommodations, Federal Reserve that comes forward, as well as some of what we may be getting from the legislative branch. So, no, I don't think 2026 is going to be a particularly troublesome year. I actually would expect it to have more of a recovery type feel, a recovery from a soft patch that we're going to be heading into here, given the lack of clarity right now that businesses and consumers have. So I remind investors, markets are forward looking, priced in a bad outcome quickly. We've come back from most of that. And, again, does the policy mix get better from here? And if it does, you'll probably start to see more of a recovery-like trade in markets.
Well, Brian, I'm looking forward to that conversation. We'll see if it lives up to what we're expecting today. Meanwhile, thanks so much for today's conversation. I appreciate your time.
My pleasure, Chuck. Thank you.
That's Brian Levitt. He is global market strategist at Invesco, which is online at Invesco.com/US. Again, there is a direct link to their mid-year outlook in our show notes. And we will be back to put a bow on this show this week on Money Life, and we'll set you up for what's coming next week before we cross the finish line right after this message. This is Money Life.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
So it's another week already.
It sure is hard to believe that it's another week because we're now at the start of summer, the longest day of the year. Days will start to get shorter. I really don't understand where time goes. Days are long, but years are short is what we prove here, I think, all the time. But the days here have been great. I hope you've enjoyed the interviews. I think we've had just top quality stuff, and we've got a lot more coming. Next week on this show, big interviews include Sam Millett, Senior Investment Strategist at Commonwealth Financial Network, Stacy Mintz, Head of Quantitative Equity at PGIM Quantitative Solutions, Daniel Morris, Chief Investment Strategist at BNP Paribas Asset Management, Matthew Miskin, Co-Chief Investment Strategist at John Hancock, all coming next week. Plus, we've got Ed Schill from Wealth Enhancement Group, the QCI team. Richard Howe, editor of Stock Spinoff Investing, is back in the market call and more. So great things coming. Sorry that we did not have Jeff Crumpleman today, but we will get him back as soon as we can. And oh, by the way, John Kosar from Asbury Research, Chief Market Strategist there. He will be here on Tuesday's show next week. So plan to be here. Lock us in. It'll be worth your while. Meanwhile, if you are looking for something to celebrate, well, because it is the longest day of the year, it's National Daylight Appreciation Day. It is International Surfing Day. It is National Flip-Flop Day. It is National Seashell Day. All of those things related to that. But it is also Cuckoo Warning Day. Yeah, not sure why. It is National Take Your Dog to Work Day.
Did that dog just say hi there?
Well, my dog is with me at work every day, so it would be the unusual day when he's not. It is Anne and Samantha Day, which celebrates Anne Frank and Samantha Smith. You probably know who Anne Frank is. If you don't remember Samantha Smith, she is the young girl from Maine who wrote a letter to Yuri Andropov in 1982, asking him if he was going to start a nuclear war with the United States. Wound up going over there, etc. Ultimately was killed in a plane crash, but she set this incredible example and worth remembering. By the way, it is also National Hike with a Geek Day.
You say geek, I say expert.
And then on the food front, it is National Queen Amman Day. A Queen Amman, Kouign. I don't know how that goes to Queen, but that's what it is. A Queen Amman is a round, crusty cake made with a yeast-raised dough. Basically, it's a butter cake, and it was popularized in the 1860s when flour was scarce, but butter was abundant. It's kind of a croissant meets a donut, and they're good. If you've never had one, today would be your day to try it. It is also Plain Yogurt Day. It is National Smoothie Day, and I don't understand why you'd have National Smoothie Day on the same day you have National Ice Cream Soda Day and National Vanilla Milkshake Day. Well, if your milkshake brings them to the yard, they're not going to have an ice cream soda or they're not going to have a smoothie. So, yeah, I don't understand why they're all on the same day. But they are, so, go celebrate with some of them. My guests today were John Cole Scott, president of Closed End Fund Advisors, CEFadvisors.com, CEFdata.com. Nate Astle, certified financial therapist at Beyond Finance, beyondfinance.com. And Brian Levitt, global market strategist at Invesco. It's Invesco.com/US. We do have the direct link to their mid-year outlook if you're looking for more on that. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog, who's at work with me today and every day. But he's not allowed to do that when we're working. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day is a Chinese proverb that goes like this: you can't smell the roses from a galloping horse. Yeah, it's the weekend, so slow down and smell the roses. Take advantage of what you've got. Enjoy some time with your family, your friends, or just relaxing. Keep everything in perspective. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great weekend, everybody. Stay safe and calm. We'll see you here again on Money Life on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Looks like I picked the wrong week to quit drinking.